Before every takeoff, I run through the instrument panel again, not because I expect a problem, but because discipline is what keeps small surprises from becoming big ones. That is what thesis check is. You buy stock because you believe in the business. Then the new earnings come out. And the real question is not whether the stock moved. The real question is whether the business has changed. Did something change in the instruments, or is this just turbulence? Today, we're going to run the check on BlackRock BLK using 2025 results. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. By the end of this video, you will know what improved, what still needs to be monitored, and whether BlackRock Thesis is improving, unchanged, or weakening. Let's go. As I said in day 7, if you cannot explain a company simply, you should not own it with conviction. So here is my BlackRock thesis in a few sentences. BlackRock remains a permanent position in my portfolio because it is the dominant asset manager in the world, and the bigger it gets, the harder it is to challenge. For every dollar of AUM strengthens the flywheel, lowers cost, more clients, deeper relationships, widen technology, and the brand moat. This is not just a company gathering assets. It's a business collecting fees on almost everything the market does. Passive, active, private markets, insurance, and increasingly technology. That is the thesis anchor. Now, let's see whether the latest results strengthen it or weaken it. Now, let's start with the numbers because the numbers tell the story. BlackRock finished 2025 with 14 trillion AUMs, up from the prior year. Full year revenue reached $24 billion, up 19% year over year. Net inflows came at $698 billion, all-time record. Adjusted earnings per share finished at $48.09, up 10%. In Q4, the momentum stayed strong. Quarterly inflows were at $342 billion, another record. Quarterly revenue came in at over $7 billion, ahead of estimates. Q4 adjusted earnings per share, $13.16, ahead of estimates. But the number I care about most is organic-based fee growth. For the full year, that came in at 9%. In Q4, it accelerated to 12%. That matters because it tells us the engine is not just being lifted by the markets. Clients are actively choosing to put money with BlackRock. Add in the $527 billion from iShare inflows and a 10% dividend increase to $5.73 per quarter. And this is not a borderline report. It is a broad-based strong year. Now let's talk about the engine. BlackRock's AUM went from roughly $7.9 trillion in 2022 to $10 trillion in 2023, $11.6 trillion in 2024, and now $14 trillion in 2025. That is a massive recovery and expansion in just 2 years. And for BlackRock, more AUMs is not just a victory metric. More AUMs means more fee-bearing assets. More fee-bearing assets means more base fees. And because the platform already has scale, a lot of growth carries very strong economics. The most important detail is the Q4 organic base fee growth hit 12%. This tells me it is not only market appreciation doing the work. The business is gaining real client momentum. In aviation terms, this is not the airplane riding on tailwinds. The engines are still pushing. This is where the thesis gets more interesting. BlackRock is no longer just the king of public market asset management. It is making a deliberate move into higher fee, stickier businesses. First, GIP added more than $10 billion in infrastructure AUMs and contributed $230 million to Q4 2025 fees. Second, HPS brought in a large private client platform with roughly $220 billion of pro forma client assets. And third, Preqin, and I may be butchering that name, folks, I do apologize, is still pending, is meant to expand BlackRock's data and analysis reach in private markets and plug directly into Aladdin. Put those together, private market plus technology are expanding to exceed 20% of total revenues on a pro forma basis. That matters because this is not just more revenue, it's better revenue, higher fees, stickier capital, less commoditized. That improves the quality of the business over time. A good quarter is one thing, but as we talked about it on day 3, a durable moat is something else. BlackRock has 4 core competitive advantages. First, scale. At 14 trillion in AUMs, the cost structure is almost impossible to match. Lower fees attract more inflows and more inflows reinforces the cost hedge. Second, iShares. This is the #1 ETF franchise in the world, with $572 billion in inflows in 2025 alone. Third, Aladdin. This is not just a support tool. It is a risk infrastructure used across the industry, including firms that compete with BlackRock. Fourth, relationships. Institutional wealth insurance relationships at this scale do not unwind quickly. On the doc notes, $700 billion managed for insurance companies alone. And now there is a possible fifth layer building: private markets. If BlackRock executes well on GIP and HPS and Preqin, the moat gets wider, not narrower. As I said in day 5, no honest thesis check skips the bull case or the bear case. So let's look at both sides. The bear case. GAAP earnings fell 16%, even though it was largely driven by non-cash acquisition charges. Integration risk is real, with multiple deals happening at once. Fee compensation is that passive remains a structural headwind. Private credit adds cyclical exposure, and at 14 trillion, future percentage growth naturally gets harder. And if the market sells off sharply, AUMs and fees can compress quickly. Bull case. Record inflows are real. Organic base fee growth reaccelerates to 12% in Q4. Private markets are shifting the mix toward higher fee revenue, and Preqin extends Aladdin's further into private assets. Management raises the dividend by 10%, and the base fee run rate entered in 2026 is about 35% above 2024 levels. So this is not a one-sided story. There is real risk, but there is also real operating momentum. Now, the verdict. After running the thesis check, my conclusion is the thesis status improving. Here's why. AUMs reached $14 trillion, so the scale moat is widening. Inflows have remained exceptionally strong. The private market pivot is becoming tangible, not theoretical. Organic base fee growth re-accelerated to 12% in Q4. Management raises the dividends and expands the buybacks. And the base fee run rate entered in 2026 is materially above where it was in 2024. What I am still watching is the headline GAAP numbers will stay noisy because the acquisition rate charges. The integration risk is real. Private capital will need to be monitored in a downturn, and the valuation still looks like a main risk, not a business quality. That is the key distinctions. The business looks strong, the stock may still be expensive. Those are not the same question. And for BlackRock right now, I think the business is winning faster than this market is giving it credit for. But the margin of safety still matters. Now let's talk valuation, because this is where the thesis meets discipline. For BlackRock, I'm not using one blatant metric and calling it done. My primary instruments are PE versus 5-year average, dividend yield versus 5-year average, adjusted operating margins, and organic base fee growth. Those are my main gauges because they tell me whether I am paying normal multiple, whether the stock is offering a better than normal yield, and whether the operating engine is still strong. My backup instruments are EV to adjusted operating income, ROE, EV to free cash flow, and PEGY. I do not lead with PEGY or EV to free cash flow for BlackRock, but I like them as secondary checks when price starts moving into a more attractive territory. So here's how I frame the zones. Fair value, 800 to 900. That is a reasonable zone when the thesis is intact and the stock is trading around its normal forward multiple with normal slight to better than normal yield. Attractive, 700 to 800. Now you're getting below the historical PE. The yield improves. Backup metrics like the EV over adjusted operating income and PEGY start to look more favorable. Compelling, below $700. That would suggest either the major market dislocation or a serious temporary scare. If the thesis remains intact there, the margin of safety becomes much more meaningful. Above 900, I would describe the stock as stretched. The thesis may still be strong, but the valuation gives you less room for error. Larry Fink said on the earnings call that BlackRock entered 2026 with accelerating momentum across the platform, coming off a strong year and a quarter of net inflows in history. I think that is the right frame. When I look at BlackRock now, I see a company with strong scale, strong flows, better mix, and a wider long-term moat. I also see a stock where valuation still matters. So my conclusion is not that BlackRock is risk-free. The thesis itself looks stronger today than it did before the report. That is why my call is BlackRock Thesis improving. That concludes my thesis check on BlackRock. I'm Captain Pierce with SkiesCapital. Think clearly, invest better. This has been for educational purposes only, not investment advice.